Good afternoon, everyone. Thank you very much for joining us today. I'm Caroline Player, and on behalf of the Georgia Tech Alumni Association, I do welcome you all. We are obviously in for another treat today as entrepreneur Lara Hodgson guides us through the process of overcoming barriers to action. She is obviously going to lead us today in a discussion on business credit scores. Before we get started, let me tell you a little bit about Lara. She is president and CEO of Now Account, has launched product and service businesses, raised capital, and served in executive management roles with Nourish, Dewberry Capital, Dunk, and IXL. Lara has extensive experience in brand development, corporate strategy, business development, marketing, and operations. She's worked with companies such as Nike, Coca-Cola, the Home Depot, Keds, and others. Lara received an MBA from the Harvard Business School and a bachelor's in aerospace engineering with highest honors from Georgia Tech, where she was a scholarship member of the varsity track team and was named one of the top 20 students in the United States by USA Today. She was also selected to study in Japan with U.S. Department of Defense. On top of that, she served as an ambassador to Lebanon for the 1996 Olympic Games. Lara is an adjunct instructor in graduate finance classes at Georgia Tech's Scheller College of Business and serves as a founding board member of Atlanta Heights Charter School. Lara served on the boards of Flag Bank, the Society of International Business Fellows, Central Atlanta Progress, and Georgia Tech's Alexander Tharp Fund. Lara is a member of the Leadership Atlanta class of 2004 and Leadership Georgia class of 2005. She was honored by the Georgia Tech Georgia Tech Athletic Association with the Total Person Alumnus Award and by the Georgia Tech Women in Engineering organization as the Alumna of the Year. Lara is a member of the Georgia Tech Young Alumnus Hall of Fame and is internationally recognized as a speaker on innovation and in creativity. And we are super lucky today because she's chosen to speak with us on her birthday. So thank you, Lara, for being here. By a matter of housekeeping, you all who have participated in the past know that we conduct about 45-minute presentation, follow that with Q&A. So do save your questions or go ahead and type them in when you have them, and we will get to them at the end. I also wanted to mention that we have BizTech coming up on June 2nd. Lara will be our speaker for that program over in the Clary Theater on campus. The topic of her talk is Leading Through Disruptive Change, and I hope that you all will join us for that program again on June 2nd if you're here in the area. So without further delay, let me turn this over to you, Lara.
Thank you. Well, it is a pleasure to be with everyone. Yes, on my birthday, and we won't share which one it is. We're starting to count backwards now. And I do apologize for my voice if I coughed during the middle of this. I'm also dealing with the pollen that we're all celebrating here in Atlanta. But it is great to be with everyone, and I laugh because I just remember when we were setting up the topic on this one, thinking to myself, why would I want to spend a lunch talking about credit scores? I can't think of anything more boring. But hopefully we'll make it a little bit fun and share with you some information that I wish I had known when I started my business. So, you know, it's interesting when I talk to people, and I've done presentations like this with Chambers of Commerce and other groups, and often I'm doing it with the folks from Equifax, who are our partner, but I always start out asking people how many people know they have a business credit score. And I don't know whether it's surprising or not, but usually it's about less than 10% of the room even have an idea that there is such a thing as a business credit score. And it's interesting because I can remember the first time I experienced the shock of what not having a good personal score can do for your ability to do basic things like, you know, get a house or a car or what have you. And, you know, it was funny because my husband and I had applied for a loan, and they came back and said that I didn't have a high enough score. And I thought, how is that possible? I have had, you know, credit cards my entire life, ever since I graduated from Georgia Tech. I've never missed a payment, but it turned out that over the course of, you know, getting married, buying a house, and we had bundled things together so that we only had one bill instead of multiple bills. And in doing that, I had become a card holder, but not an account holder. And so, you know, it's things like that that we try to all be really careful about with our personal credit and make sure that we have scores and that we monitor them. but no one had ever told me that the same thing was true for businesses. And so when I started my first business and started growing it, it wasn't an issue until I got to the point where I did need equipment financing and some of the other types of capital that all of a sudden, you know, I was turned down for, not because I had a bad score, but because I didn't have one. And I thought, how's that possible? I've had my business for this long. And it was because when I had started my business, I had used my personal credit cards, or, you know, I had started it with a small local community bank that didn't report any of my behavior. And so it made me really cognizant of the fact that these scores are important, and I think they're becoming more important. So as I walk you through kind of how the evolution of the scores work, how do you find your score, what does the score even look like, I'll also share with you sort of how I experienced being on the end of having to build a score, but then also the business that I have today, all of our decisioning is done based on your business credit score. So if you don't have one, literally 15 minutes ago before I got on this call, a friend of mine had applied to have a Now account, and I know him. I've known him for years. He's got a great business, but he doesn't have a score. And so we can't approve it, and that's frustrating to not be able to help somebody because it's something that none of us knew about. So with that, we'll go ahead and move forward in terms of the slides, and I'll kind of share with you why this is so important. So when you think about being a small business owner and people ask you about business credit or credit scores, we typically think about it from the perspective that we're borrowing, right? So you might go down to your local bank, whether it's a large bank, a community bank, a credit union, and try and get a term loan, or maybe you're trying to get a loan for some real estate if you need to build a warehouse, or maybe you're trying to get a line of credit to help cover cash flow issues. But we typically think of ourselves as users of credit. And what's interesting is, in some cases, we use credit that others give us. But at the same time, what we rarely think about is the fact that we, as the small business owner, we extend credit every day. So we're not just using credit in terms of credit being extended to us from a bank or, you know, private equity or other types of lenders. But in many cases, we are extending credit to our customers. And we do that every day when we send someone a product or we deliver a service, and then we send them an invoice. And I sort of joke, the other day someone asked me what I thought about, you know, this new craze in P2P lending. And I sort of laughed and said, you know, P2P lending isn't new. In fact, it's older than any of us are. And it looks like an invoice. And that's probably the oldest form of P2P lending, where my small business has loaned your small business money for the next 30 days because I've told you that you don't have to pay me until then. And so as you think about your credit score, think about it not only from the perspective that you're going to be borrowing capital, and so having a strong score will enable your business to have a lot more options, but also think about it from the perspective that you are often lending to your customers, and if their behavior is slow, it will hurt your score. Because there are times when I'll look up a business's score and it's low because their customers take so long to pay that they then are late on paying some of their obligations. So, you know, kind of think of it as an ecosystem, that your business doesn't exist in a bubble, and it may not be your behavior. In fact, I can remember with my last business, Nourish, almost every time that I had to call one of my vendors and apologize with my hat in my hand and say, can I have a few more days to pay you, it was always because I was waiting to get paid. And so, you know, here again, someone else's behavior affects my behavior, and then my behavior can reflect poorly on the overall business score. So make sure you think about all the different roles that you play in terms of extending credit. And I may have shared this before. I just love Dilbert cartoons, and you know, I found this one, which sort of epitomizes what we're talking about. And here, you know, this gentleman is saying that he's decided your tiny company is going to give him an interest-free loan. You don't even have to sign any paperwork. He's just going to pay you late. And the part I like the best is the small businessman is saying, I demand no snorkeling, because he really has no power to demand anything. So he came up with that one. But that's really where most of us as small business owners find ourselves, is in that in-between space where we're trying to establish good credit behavior so that we can access capital, but we're also then turning around and letting our customers have our money for free for a very long period of time, and then their behavior impacts us. And so when you think about credit reporting, what's interesting is to think about how it evolved. So, you know, years ago, and many of us sort of remember this, I remember as a little girl every month going with my mother downtown to the Riches store to pay the Riches bill. And it's interesting because the entire basement of Riches was the credit department. And what Riches would do is they would offer their customers credit, or basically a house account, like the old Cheers television show where you had a tab. But retailers would offer their best customers house accounts knowing that you would spend more money, right? If I let you not pay me cash or write a check that day, then you would spend more money. But the limitation was you could only get credit from a merchant or a retailer that knew you. So, for example, my mother would have credit with the Riches store in Atlanta, but if she happened to be up in New York, she would not have credit at any of those stores. And so each store offered its own credit, and they managed that because they, for the most part, knew something about you. But over time, an entity that actually started out known as retail credit started out, and what they would do is they would aggregate all of the credit information from all the local retailers, package it into a big report, and then sell it back to the retailers. So essentially what they were enabling was Riches to make a decision on my mother based on the experience that Macy's had had. So for the first time ever, these retailers were able to pool all their information together so that they could decide whether or not to offer you credit. And as that evolved, so you started having local reporting offices, but everything was still very local. Early on, corporate reports started to be created where they started to collect business data, not just personal data, and start to create reports. That wasn't until the 1930s. It really wasn't until the late 60s that reporting started to be automated. And, you know, one of the things that I always talk about is sort of unintended consequences. Some are good, some are bad. But if you think about it, the reason that the credit card evolved to the point that it is today, where every single one of us has not one but probably two or three in our wallet, is because long-distance phone charges became cheap enough. And isn't that funny? Because the two seem completely unrelated. But before that, when there were still ladies, you know, making long-distance phone connections, there was still the telephone woman, you couldn't have had a credit card work because a store in California could not have figured out whether you had credit or not. And so it was because long-distance phone charges became so cheap that credit card companies and merchants were able to ping your file from across the country instantaneously. And at that point, retailers got out of the business of offering credit, and instead we all started to carry things that looked like Visa, MasterCard, American Express. And so that credit became consolidated. But what's interesting is all of that data was still consumer data. And so you and I know that we have FICO scores, and those scores do not tell the retailer anything about how much money I have in my bank account, right? So you can have a very strong score and have no money in your bank account. You can have lots of money in your bank account and have a really bad score. And so the score is not measuring how much money you have. What it's measuring is your past behavior and whether your behavior is indicative of a person who will pay their obligations on time. And so as that data became more and more prolific on the consumer side and it became automated, credit cards became prolific, retailers got out of the business of having house accounts, and everything became automated. But it's really only in recent years that the same has started to happen for small business. So up until recently, if a bank wanted to decision your small business for credit, they would actually check your personal credit score. Now, you might think to yourself, well, that makes sense, because if I behave appropriately personally, that should tell you something about my business. The interesting thing is it does not. In fact, personal credit scores have no correlation to how a business performs. And part of that is because how you manage your personal obligations and how the business manages its obligations are two totally different things. You can be the most upstanding, high character, ethical person, and on your personal side, you pay everything ahead of time. But you get into business, and for a number of reasons, whether it's your customers taking a long time to pay you or something happens in the industry, the business could actually end up being late on something, and that would not be reflected in your score. Likewise, there are people that have poor personal scores for whatever reason, life events have been thrown at them, and yet their business behaves exceptionally well. So in the last, I would say it was about 14 years ago, a group of financial institutions got together, and they were struggling with the fact that there was no predictive data on the way small businesses behave. Because your personal score meant nothing, and your Dun & Bradstreet score is really irrelevant unless you're doing business with the government. And so these banks got together and formed a cooperative called the Small Business Financial Exchange, and they pooled all of their data and applied some analytics, which Equifax led the work on, applied some analytics to create a business score that is similar to the score that you would have as a person. So your business credit score, again, it is not a measure of how much money your business has in its bank account. It is a measure of whether your business has historically performed in a behavioral way that is appropriate. Have you paid your obligations on time? And so as we continue along our timeline, in the late 60s, automation first came in. It wasn't until the early 2000s that the first small business report started to be created. So it's really not that long ago. I mean, we're talking about maybe 10, 15 years ago when this entity came together to create small business credit scores. And that's why none of us know we have them. I have people all the time that call me and say, well, I can send you my personal credit report, but they don't realize that, again, that's not the same thing as a business report. Today, you've got a pretty sophisticated mechanism for financial institutions and other entities that extend credit. So think about Dell computers or Pitney Bowes, if your company happens to have one of those little machines for doing postage. All of those folks extend you credit. Pitney Bowes does it because, there's a certain amount of money that's on your machine, and then they bill you at the end of the month, and you pay for the postage that you had. But at the end of the day, all of those folks are now part of this cooperative, and they're contributing data, which means if you're late paying an obligation to them, that will get reported. And so it's important to think about sort of how those reports are coming together. So if you think about your personal report, and this is just a copy of what one looks like, your personal report comes together by aggregating data from credit card companies. Are you paying your credit card bills on time? Mortgages, so obviously, paying your mortgage payments on time. Any type of loan, whether it's a personal loan, an auto loan. Also figured in is other public data like bankruptcies, if you've ever had a personal bankruptcy or there's ever been a judgment or a tax lien or a wage garnishment. All of that goes into the sausage maker, and what comes out is a score. And most of us know enough about the scale that we know that, for example, if you have a score over 700, that's a good score. If you have a score that's under 700, then you have some things that you need to work on if you want to be able to access large amounts of capital at the best price. And so as you think about that as a an analogy, these personal credit reports, when you get them, it has your employment history, it has public records, it has any collection items that have ever been on there, your payment history, all of that goes into your report. But, as we mentioned before, what most people don't know is that your business also has a credit report. Now, one thing I will tell you is that, a lot of people say, well, I started my business and I just use my own personal credit cards. And I cringe when I hear that, because if you set up your small business and you don't set it up to have a life of its own, then you're putting not only your business but your personal life at risk. There are a number of things that could go wrong with your business that have nothing to do with you. It could be the industry or something happens. And that would affect your personal credit if your business is riding on your personal credit. Likewise, you could have a health issue or something that goes wrong in your personal life that would tank your business. So I always tell people, when you start your business, make sure that you set your business up to have its own credit, not your personal credit. And I know that that's easier said than done, because there are bankers all over the place that will grab your personal guarantee as quickly as they can on a business loan. I always like to point out to the bankers that if you give me a business loan and I have to sign a personal guarantee, you've now given me a personal loan to my business. So, again, do whatever you can to keep them separate. But as we look at what a business credit report has, some of it looks very similar to what was on your personal credit report. So if you have a business credit card, not your personal Amex, but if you have a business credit card, if your business owns real estate, if your business has loans, if your business has its filing with the Secretary of State needs to be up to date, if your business has ever filed a bankruptcy or has ever had tax liens filed against it, that will affect your business credit score. But in addition, unlike your personal score, there are some other sources of data that will affect your business credit score. One is, and a big one, is utilities. So if you have an office and you pay cable bills, telephone bills, voice over IP bills, anything related to utilities, most of the big utility companies do contribute data into these business databases. If you lease equipment, so if you have copiers or fax machines or some of these other things that you're leasing, a lot of the large equipment leasing folks also report in. And then finally, some of your vendors and suppliers may or may not also be reporting into this system. So if you are late paying your obligations to, your suppliers, that could also adversely affect you. And so at the end of the day, when you get your credit report for your business, like your personal report, you'll see a profile of your company. There's usually some alerts on there showing that if something is late, if you've had charge-offs, if you've had tax liens filed, if you've had bad or good credit experiences, and they typically separate out financial from non-financial. So financial would be anything related to a bank, and non-financial would be anything reported based on utilities, et cetera, that are not banks. So when you think about where is a score used, how do I even get one? Think about the life cycle of your business. So on this chart, from the minute where you see entrance, from the minute that you start your business, whether the first thing you do is hook up a phone, whether you open a bank account, whether you buy materials from a vendor, whether you, if you're a retailer, maybe you're opening a storefront. All of those things will start to establish credit for you. And again, think about how you're managing that in terms of, make sure you set up an account, but don't set up too many. Now, once your business gets past the early stage and starts to maybe tap into lines of credit or loans, insurance policies, leases, those types of things will continue to add to your business's credit score. And then ultimately, hopefully your business never gets to the dark gray part of my chart here, because that's the end, and we don't want your business to end. But as you start to get into issues related to collections or bankruptcies, that, of course, all ties into your score as well, unfortunately, in a bad way. So think about all the different entities that you touch as a small business owner outside of your business and how that affects your credit score. And again, you'll see on here right about where early stage meets middle stage, you'll see B2B AR/trade. That is where you're allowing your customer to pay you later. And the minute you start doing that, you put your own credit score at risk, because if they're late paying and that puts you into a crunch and you can't pay your vendors on time, then your score is going to be adversely selected. But think about as well, when you have a customer that wants you to give them terms like net 60 or net 90, how do you decide whether to do that? Now, I asked that to someone one time and they laughed at me because they said, well, I don't decide, I get told. Meaning my customer tells me, you know, I sell to Coca-Cola and they tell me I have to give them net 60. But, and that is true. A lot of your big customers probably dictate the terms that you have to extend to them. But there are times when you have a decision to make, which is someone wants to buy product or service from you and they ask you if you can send them an invoice, if you'll extend them credit. And you have to decide, how much credit are you going to extend? Are you going to extend it? Well, how do you know that? I remember making a decision at a trade show once that someone placed an order and they didn't have a credit card, and I thought, well, I've heard of them before, so I'm sure they're good. And of course, they never paid me. So the fact that you've heard of a customer before does not mean that they're likely to pay you. So think about yourself, again, both as the user of credit and as the extender of credit. And so when we think about business credit scores, I'm just going to go ahead and build this, all these little smiley faces. There's really a couple of different inputs that go into it. So your score is coming from all this data from financial institutions and utility companies and your suppliers. And so a lot of what's going in there is things like your payment history, the amounts that you have at work. So this is, I often joke that lines of credit should be the topic of a Seinfeld episode, because the fact that someone is willing to give you a $500,000 line of credit does not mean you're supposed to use $500,000, because the minute you do that, that will hurt your credit score, which means you will then have a harder time accessing credit. So when someone gives you a line, you're supposed to keep probably 20% plus liquid at all times. I know that seems strange. Well, they just give you a $300,000 line if you're not supposed to use the $500,000. But again, if you have these lines of credit, if you have credit cards, if they're maxed out, that will hurt your score. Another thing that helps your score is the length of credit history. So if you open a business account and you decide a month later that you don't need it and you close it, that actually hurts your score. If you have a business account and you leave it open, even if you don't use it, that helps your business score. So again, looking at the length of time that you've had various things operating. And so when we look at business credit scores, what we're really looking at is two different scores. One is called a delinquency score, and it is the likelihood that your business will pay their obligations within 90 days. And so if you have a delinquency score that is good, it means that historically and going forward, you are likely to pay your obligations within 90 days. If you have a poor delinquency score, then that means that either historically you have been delinquent in the last 12 months, or going forward, you are likely to be delinquent based on your past behavior. The score that I find most important, however, is what's called a failure score. And what that is looking at is the likelihood that you, as a small business, would go out of business in the next 12 months owing creditors. Businesses go out of business all the time. Bankruptcies are rare, exceptionally rare. But that's what it's trying to measure, is what is the likelihood that in the next 12 months you will go out of business. And not only go out of business, but you will owe creditors when you go out of business. And so that failure score is actually the score that is used maybe even more importantly than the delinquency score, because that's the risk that an entity is Not only do they want to know that you'll be able to pay it back, which is the delinquency score, but most importantly, they want to know that you're going to be around to pay them back at some point. And then there's another report you can also get that helps you if you were pulling your customer's credit score to decide whether you would want to extend them a certain amount of credit or not. So remember, sort of different scores mean different things. One of the things that I find, I'm trying to think of the right word. I find it maddening, that's for sure, but I find it a little bit disconcerting is that the way small and medium-sized businesses are looked at from a scoring perspective is very unique. And when you look at this, it will sound, and it actually is, double standards compared to large businesses. So the interesting thing is if you look at a large business, a Fortune 500 company, they typically pay late. They don't pay late every once in a while. They always pay late. But that doesn't seem to hurt their rating or their scores. In fact, in many cases, the market celebrates these brilliant large companies that are smart enough to manage their cash by not paying their suppliers right away. On the other hand, if you're a small business and you are late paying, that is translated into a danger of failure. And so it's completely unfair. It is absolutely a double standard. But as a small business, the fact that your large customers are paying you late does not give you a buy where you can pay your obligations late, because for you it will actually reflect badly on your score. The interesting thing is that unlike large businesses, part of the challenge is there's not a lot of data available on small businesses. So this score that I mentioned that's been developed over the last 13 to 15 years is going a long ways towards establishing that type of data. But because there is so little data, that's why the conclusions are made that if you're late paying, you must be on the verge of failure, as opposed to saying if you're late paying, it's because you've got a customer that's taking a long time to pay. But I think that part over time will get better as more data ultimately gets aggregated. The other thing that's interesting is if you look at your personal credit score, the more times it gets checked, the lower your score is, right? So if you pull your personal score and you've had a number of people run your score, maybe you were trying to get an auto loan or a home loan, as you know, you don't want a lot of people to ping your score because that actually hurts your score. With small businesses, that's not the case. Small businesses are going to have a lot more inquiries, right? Because every day you're selling to other customers and you're extending credit. Every day people are selling to you and checking your credit. And so the fact that someone checks your credit does not hurt your business credit score. Businesses, of course, are expected to carry more credit, larger balances, et cetera, but it's because of that that the consumer score doesn't necessarily correlate to a business score. So it's actually a good thing that there's now the development of business-only scores. And so probably the number one question that I get from folks is, if they don't have a score, well, how do I get a score? And once I have it, how do I make sure that it stays strong? Because unlike personal credit scores, there's not just these free websites you can go to and monitor your score. And so I always give sort of the following advice. First and foremost, when you start your company, as quickly as possible, cut the ties between you and your company. And by that I mean financial ties, obviously, because you're running your company. But trying to keep your personal financials and your business financials separate will give both your personal and your business the opportunity to stand on its own. And the quicker that you can do that, the better off both sides of the equation will be. The next thing I always tell people is as soon as you have set up your business, go apply for a business credit card. You can go to Capital One, you can go to American Express. They all have business credit cards. It's not a personal card. It's a business where the business is actually ultimately jointly the obligor with you, the person. But go ahead and sign up for a business credit card. And even if all you do is buy some paper and pencils and pay it off each month, So put $100 on it. You know, take your team to lunch. You know, buy some office supplies. Pay it off each month and start to establish that precedent that you pay on time, because that will go a long way in establishing a strong score. Even if you're a very early stage company, you'll have a strong score so that when you are looking for some larger dollars, you know, from a loan or a large credit card, you'll have the capacity for that. This may seem obvious, and I already said it, but pay your bills on time. And that can't be overstated. Don't overextend those cards to the point where you can't pay them on time, because that will drastically affect your score. And then the next piece is sort of my Seinfeld episode comment, which is manage your utilization. Maxing out your line of credit will hurt your credit score. Maxing out your credit cards will hurt your credit score. And so make sure that when you have an account that you're always keeping a little bit of it liquid. And the rule of thumb that I always tell people is you have to use the right type of capital from the right source at the right time for the right use. And if you get those mixed up, then your business will quickly become a hobby. Hobbies are things that don't make money. And what I mean by that is I run into people all the time that have a line of credit, and they draw on that line of credit and they go buy a piece of equipment. That is not the right type of money at the right time for the right use, because the line of credit is short-term capital. It's meant to be turned, meaning you draw on the line, you pay it back, you draw on the line, you pay it back, you draw on the line, you pay it back. It's not meant to be drawn on for something that is not going to generate immediate dollars, like a piece of equipment. A piece of equipment is better funded through a term loan that aligns with the expected life of the piece of equipment. And so make sure that you don't view every dollar as equal, because they're not. A dollar from a line of credit is very different than a dollar of revenue, is very different than a dollar of equity, is very different than a dollar in a secured loan. So make sure that you are looking at the right dollars to use in the right way at the right time. And then finally, monitor your business score. There are ways, and I'll share with you what some of those are, but people always ask me, do I need to have a DMV score? If you're doing work with the government, absolutely, you need to have a DMV score, because that's what they check. If you're not, you probably are not going to need it on a daily basis, but that doesn't mean you shouldn't have it and make sure that it stays strong. Likewise, and I'll give you the information that you can go to find your Equifax business credit score as well, but make sure you get a copy of your business credit report and make sure that you keep on top of that and know that it stays strong. You do have to contact each bureau individually, so the fact that you check DMV does not mean anything happens with Equifax. If you check Equifax, it doesn't mean anything happens with Experian. So you've got a number of different credit bureaus that all manage their own scores. And so what does that mean for the future? I think if you look at what happened with consumer credit, there was a time when you would go to buy an automobile and you would actually have to share your financials, your personal financial statement. Today, when you go to buy an automobile, you don't tell anybody your personal financials. They type in your name and your social security number, and instantaneously they get a score. And they make a decision based on that score. The same thing is going to happen with business. It's still going to take some time. We're probably still several years out from it becoming the sole decisioning, but it has gotten to the point, 20 years ago, it wasn't even considered in the decision. Today, it absolutely is considered. Almost every bank will run your score. Now, they will still collect all of your financials and do their underwriting, et cetera, because the scores haven't been around long enough for them to sort of rely on that. But mark my word, at the end of the day, when it costs them $1 to pull your score, but it costs them several $100s to pull through all your tax returns and your business financials, there will come a day in the not-too-distant future when the score will be the decisioning, meaning if you don't have a score, you don't get the loan. If you don't have a score, you don't get the line of credit. If you don't have a score, you don't get the equipment lease. And so what I tell people is start to understand it today, because when that day comes and you absolutely need that copy machine, you don't want the answer to be no, because you didn't have a score, and you don't have a score because you didn't even know about it. So I just want to give you an example, and then I'm going to stop and take questions. But I just want to tell you how we use your credit score. So at Now Account, the company that I have, what we're doing is we help small businesses that sell to other businesses and governments. They can have a Now Account, and when they get ready to invoice their business or government customer, they can put that transaction on a Now Account. They get paid immediately in a way that feels like taking a credit card. So there's a flat fee, there's no loan, there's no debt or liability. They get their revenue immediately, and in return they pay a flat 2.5% merchant fee. Their customer still gets the invoice, still pays when they feel like it, and never actually knows that Now Account exists. So essentially what Now Account has done is we have connected the dots. Whoops, I just hit my. We have connected the dots between the small business seller of a good or service and their customer. The small business seller feels like they took a credit card. Their customer feels like it's still the old accounts payable because they get an invoice, make the check out to the supplier, and pay when they feel like it. The way that Now Account uses credit scores is when a small business comes to us and applies for a Now Account, which they can do online in about 2 minutes. The very first thing we do is we take the business's name and address and we look at their credit score. So all we need is a business's name and address. I could take out the yellow pages today and run everybody's credit scores because unlike personal scores, you don't need permission. It doesn't affect their score. But when someone comes to us and applies for a Now Account, the first thing I do is check their score. If they don't have a small business failure score that is sufficiently high based on our definition of a threshold, they cannot have a Now Account. And it is amazing to me how many times, in fact, it's multiple times a day that people call me and they're like, but why can't I have it? I have a great business. I have a contract with Coca-Cola for $50,000. What we typically find is one of three things. Either their score will come back as a no match, which means they're not even in the database. And I have seen businesses that are more than a year old that are not in the database because they never established credit. They didn't set up a business credit card. They didn't bank with an institution that reports. And so as far as the credit world is concerned, that small business doesn't even exist. For those folks, what I always tell them is what I told you earlier, go ahead and get a small business credit card, put a few purchases on it, start paying it off so that you have that score. Sometimes we'll get a report back and it says unscorable, meaning they have a report. I mean, there's a match. They are in the database, but there's not enough information for there to be a score. Now, it's funny because I have had brand new startup companies that have only been around for maybe 3 months have a score. And then I've seen businesses that are 2 and 3 years old show up unscorable. And again, that reason is, how did you set up your business? The 3-month-old company clearly started out, set up a bank account, got a business credit card, and started to establish credit. The other business probably used their personal Amex and then just reimbursed themselves. They probably didn't rent anything. They probably, they may just use their own personal mobile phone. And so that business never established a score. Then we get folks that either have a high score, which is great. It means they've established credit and they've behaved appropriately. Or there's folks that will have a low score, which obviously means that they've either maxed out an existing line, they've maxed out a credit card, or they've been extremely late paying their obligations. So that's the first way we check the score. That's looking at the small business seller of the good or service. Now, when the small business gives us an invoice with a customer, if it's Coca-Cola, we don't necessarily need to check the score because they're a publicly traded and rated company. But a lot of times, one of our clients will give us an invoice with another small business. And so what we're looking for there is that customer likely to pay in 90 days? So again, remember, there's the delinquency score and there's the failure score, both of which are important. The failure score is exceptionally important if you're extending credit, And the delinquency score is important if you're the one getting the credit, if you're the one that is paying and has the obligation. So I just want to look through. I have some now account slides in here. I think with that, we'll open it up for questions because I think we're right at about quarter till.
Great. Thank you, Lara.
Uh-huh.
If you do have questions, you all, you'll see the chat function, the chat window in the right-hand upper corner. Just open that if you need to and input your questions to myself, Lara. I'll relay it to Lara, whatever you'd prefer.
Hi, I have a question.
Okay, go ahead.
When I established my first business credit card, they actually did a credit check on my personal. Is that regular, or supposedly my personal should not get a hit in order to apply for a business credit card?
Right. So it depends on the credit card company that you're working with. Like I said, a lot of financial institutions will try to tie your personal credit to your business credit. In some cases, if you're just setting up the business, they're probably using your personal credit to make a decision, but then once you have that business credit card, going forward, the behavior should reflect on your business report, not your personal report. So they may have used your personal credit to get you the card, but then your behavior on that card should reflect on your business. You can, of course, check with the bank that you have your credit card with and make sure that that is reflecting on your business only, or in the case of a personal card, certainly your personal only. So you can make sure that they sort of bifurcate those if they're not doing it already.
Thank you.
Any other questions? Of course, feel free to take yourself off of mute also.
The one other thing that I didn't share is if you want to get your credit score, if you go to Equifax's website, there's a commercial tab on there, and there should be a way to get your business credit score. You could also check out the Small Business Financial Exchange has a website. It's sbfe.org. And I don't think that business owners can go directly into the SBFE, but I think on that web page they do have links to Equifax and others to be able to get your score. Now, I know that some of the reporting agencies, if you just call and want to get your business score, they try to charge for that. Because they're also charging if you want to pull a customer's. You can pull a customer's score too, not just your own. So unlike personal credit where you can't check someone's score without their permission, with business credit you can. So if you get a big order from somebody, before you ship that product, I would check and make sure that they are likely to pay you. So you can use it to check your own or to check your customers. But in some cases, they will try to charge. If, however, you apply for, a loan at your bank or a line of credit, or in our case, a NOW account, and you're declined, then we have to give you a 1-800 number and a website to go to, and they have to give it to you for free. So if for some reason you apply for something and you don't get it, then they have to give you your report for free.
Lara, quick question. Oh, go ahead. Udo?
Yeah, I didn't want to interrupt. I did have a question. I want to make a comment. A really interesting presentation. I've learned a lot and appreciate it. I had one question regarding your business model, and you may feel it's inappropriate and out of scope here, but I'm curious. Excuse me. You mentioned, charging a 2.5% flat fee for those firms that you do business with. I have a two-part question. Given that the customer of a business that wants to use a NOW account may have some customers that you're comfortable with and others that you're not. So I'm curious, my first question is, in your business model, do you make that distinction, or once you're in, so to speak, with a given customer, you will handle all of the business scope they want you to? That would be the first question.
Okay, well, so the way it works, when you apply for a now account and you get approved, thereafter you tell us which of your customers you want to use your now account with, because remember, it's invisible to your customer. But we don't necessarily have to take all of your customers. So we, to date, are approving 93% of the requests that we get. So we do take most customers, big, small, medium-sized. But it's interesting because what that ends up doing is giving you some insights. So what most of our clients will do is, let's say you get a purchase order, or you get an RFP, and you're deciding whether to, pursue it, and you don't know that customer. Our clients will log in a now account. They will tell us the name and address of that customer and the amount, and we will instantly tell you yes or no. We'll take it or we won't. What that now tells you is if we say no, you can, of course, still do business with that company, but you know something you didn't know before. Because if we said no, it's highly likely that you will not get paid. And so if I were you and now account said no, I might still take the order, but I would require upfront payment or require them to put it on a credit card. If now account says yes, we will take it, it's totally your choice whether you want to put that transaction on your now account or whether you want to just bill them yourself. So you can choose, you can pick and choose customers, but you can't pick and choose invoices. So if you have a customer and you decide to put it on now account and get paid immediately, every invoice with that customer needs to go on now account unless you decide to take them out, which you can do at any time because there's no term contract. So some of our clients, what they'll do is all new customers they put on now account and they watch them for 3 or 4 months and see if they're likely to pay in closer to 30 or closer to 90. And if it's closer to 30, then they take them out of now account and they just start billing them directly. And if they're always the ones that are straggling and having to have phone calls, et cetera, they just leave them on now account and don't worry about it. Does that answer your question?
Yes, it did. I had a second real business model type question. What I'm hearing is there's, just that flat fee, yes or no in terms of accepting, the customer. Curious why your business model wouldn't take the riskier clients and say, okay, I will perform the now function for you, but instead of 2.5%, it's going to be 5%. Or whatever the right number is from a risk adjustment?
Well, the answer is one word. It's simplicity. And the reason that simplicity is important to small businesses is if you came to me and said, I want to use now account with this customer, what's it going to cost me? My answer would be it depends, right? It depends on who you are, who the customer is, the size of the invoice, and all of that it depends. It's too hard for a small business owner to manage. It's just easier to put it on your now account and pay a flat fee. And if the customer ultimately doesn't pay, that's our loss. So we're managing all of that risk. That's kind of what we've patented is how we manage all that risk.
Lara, I've got one question coming in from chat. What would a person expect to pay for getting business credit reports? How much does that cost?
It depends. The different credit agencies or bureaus charge differently. I think the last time I checked with Equifax, it was like $50 to get a full business report. I know that from time to time, there'll be discounts, if you will, where you can get it for $25 or something like that. And then, of course, there's packages you can buy where you then have a certain number of credit reports you can pull over a certain period of time. And those, of course, have various pricing, especially if you're pulling your customers' reports versus your own. So each one is different, whether it's D&B, Equifax, Experian. But I do know that the Small Business Financial Exchange scores, up until kind of now, have only been available through Equifax, but that is changing. I believe later this year they'll also be available through DNB and LexisNexis, and I'm not sure about Experian.
Okay. All right. Well, that covers all the questions we had in the queue, and we're running up to the 1 o'clock hour. So thank you again, Lara, for leading this discussion, and for all of you online, thank you for participating. And we'll be back next month. And of course, don't forget about BizTech on June 2nd.
Sounds good.
All right. Have a great day.